Right, let's get cracking. So I thought what we'd do today is tax computations, and let's be honest, I've nicked a question from the AAT sample assessments, and then I've got some other questions of my own. So let's start off relatively straightforward. Where's my calculator? Got my calculator, so we're going to need that today. Cool. So can you see my screen? You should be able to see. It says task 6. James and what's not. Cool. Right. It has that horrible 3-column thing. Just gonna have to deal with it. I'll show you how I'm going to deal with it. It's not like I would do, but it is what it is. So this is taken from an AAT sample assessment 2. And when the chief examiner is asked to write some exam questions, they are not told about which will go in sample assessment and which will go in a real exam. So they are very, very indicative of what the sort of thing you will get in the real exam. Now, obviously, it's not going to be the same. Don't expect it to be the same. But this is the kind of level that could come up in your exam. If I'm being honest, if you get a question like this, you should be rubbing your hands together. This one is a doddle, in my opinion, compared to what they could get. So the way it made it more tricky is they just made you do the same thing again. It's not that hard, if I'm being honest. Right, let's get a participants thing open so I can let some people in. Cool. So what we've got here is, you can see what it says, get my pen out, task 6. So task 6, and it is, why is my pen not working? Might be better. Task 6 is 12 marks. So 12 out of 100 marks. So this is what we've got to do. So basically, we've got 2 people and split between Jonas and James. And we've just been asked, I've cut it down a bit. It does say what you need to do. But I've got rid of that just so you can see. But effectively, you'll know what you need to do. Do the tax computation. It's not rocket science. And remember, you will have the reference material available. So, you know, don't worry if you are, when you're doing any of your revision or your mocks, everything, if you're looking at the reference material, because you would get in the real exam, you're not cheating by any means. And there's certain things that you just don't want to learn, because if it's in the reference material, why would you? Cool. So let's have a look. I've split this out into Jonas and, well, I haven't. This is how the question is written. So split into Jonas and James. So we're going to look at Jonas first. So he's got income from employment, property, pension income, bank interest received, building society interest, ISA, and dividends. So the way we set it up is the way I would always do it. So you've got non-savings. My pen's having a sticky day today. Non-savings, savings, and dividends. I hate these really wide grids we've got here, but I forgot. So looking at Jonas, it's this one here. He's got income from employment of £49,000. He's got property of £15,000. What else he's got? No pension. Bank interest received of 900, and he's got building society interest received, and he's also got an ISA. Never, ever, ever. This is not in a page. This is an AAT sample assessment. Never, ever put an ISA in a tax computation. If you really want to make it really pedantic, I would actually mention that you know it is exempt because you don't think they've missed out, but just put exempt. It's dead straight obvious what it is because you've got the same figures, but technically I would be tempted to put in employment. I don't think you'd lose marks if you didn't, but actually for the purposes of students, probably should. This is property. Then you've got interest, and then you've got dividends of 11,700. I wouldn't put any narrative for dividends because dividends are dividends. Yeah, this is not an FI book, but unfortunately, I can't take credit. I did not do this question. I stole it from, this is the AAT sample assessment. So we need to take some subtotals, as you can never take too many subtotals in income tax. And this is going to be our net income. So we've got a total of 49,000 pounds plus 15,000 pounds, 64,000 pounds. Then I can do that one in my head is 1,700 pounds, and obviously that's 11,700. Now, you don't have to be a genius or good at mental arithmetic to see that his income, oh yeah, it is a him, his income is not above £100,000. So what does that mean for our next step if the income is not above £100,000? Yeah, well, there's lots of stuff people have mentioned here, but our next step is the personal allowance. So we're going to take that off. So from net income, we take off the personal allowance. Now, because he hasn't got income over £100,000, we are not going to restrict the personal allowance. We only restrict the personal allowance if the total income is above £100,000. Now, I can't off the top of my head what it is, but it's clearly nowhere near £100,000. So we're not going to restrict the personal allowance, but the personal allowance is the next thing we're going to adjust, because we take that £12,500 and we're going to take that off to come to our taxable income. That is our next step. Now I don't need those figures up at the top. I'm going to zoom in a little bit, make it a little bit easier for everyone. So take off the personal allowance, which is going to be the full £12,500, because we're not going to restrict it because the income is not over £100,000. So £64,000. Remember, we always take it off non-savings first, gives a figure £51,500. Obviously, that's not changed. That's still £1,700, and that's £11,700. Everyone with me so far? I want some coffee. Cool. So there's nothing else in this question. It's dead straightforward in terms of, and this is meant to be exam standard. This is from the chief examiner. So like I say, if you get this, you should be rubbing your hands together. So the next thing we're going to do is look at the taxing it, because we've got taxable income. So we're going to tax the non-savings income. So the first thing we're going to tax is non-savings, and we're going to tax it at the basic rate. Anyone want to tell me what the basic rate band is off the top of your head? That was quick. I even got the question out at that point. And how much are we going to tax it at? %. Yeah, so obviously his income is over and above that. So 37,500. I actually know what this is. I've done so many tax computations recently. That is £7,500. So we've taxed up to the basic rate band on his non-savings. So we now need to go and tax the rest of his non-savings. So of the 51,500, take off the £37,500 that we've already taxed, leaves £14,000, which is going to be taxed at what rate? For non-savings. That's right, 40%, 0.4, they go £5,600. Cool. So that is non-savings dealt with. We're now going to move on to savings. And what's the next? So what we're going to do is savings allowance. But how? I think everyone's getting where I'm going with this. The savings allowance now, because this person here is a higher rate taxpayer, they've got income, taxable income over 37,500, so they're a higher rate, but it is below £150,000. So they are going to get a savings allowance of £500. So savings allowance, which is £500, but it is taxed. It is not exempt. It's not like a personal allowance. It is taxed at a rate of 0%. So it is using up the higher rate band. Now, it doesn't matter in this question because we don't get above the higher rate band, but it is taking up £500 worth of the higher rate band, which is not. It is taxable income. So then we can tax the rest of the savings. So we've taxed £500 of the 1,700. That's going to leave us £1,200, not 12,000, 1,200, which is taxed at what rate? Yeah, so the higher rate for savings is the same as non-savings, 40%. It's been a long day. I'm going to use my calculator. £480. And then, so we've dealt with all the savings. So the last thing is dividends. So we know we're near the additional rate band, so we don't need to worry about that. So all of it is going to fall into the higher rate band. But it doesn't matter whether there's a basic rate taxpayer, a higher rate taxpayer, or an additional rate taxpayer. Everyone gets the £2,000 dividend allowance, which is taxed. Again, it's taxable and it uses up the higher rate band at 0%, is obviously zero. And the balance, which would be £9,700, is taxed at 32.5%, rather weirdly, but it is what it is, and it's in the reference material. Gives us 9,700 times 0.325, gives us a figure of, rounding in the taxpayer's favour, but AAT are quite generous when it comes to rounding, £3,152. So that gives a tax liability of, and we add them all up, so we've got 7,500 plus 5,600 plus 480 plus 3,152 gives a figure of £16,732. Now, if you did this question and you're a pound out because you rounded the dividend a bit differently, do not worry. AAT are more than generous when it comes to rounding. Now, good question, actually, I'm going to ask you one. We've just worked out the tax liability. So if we gave you the PAYE figure, what would the figure we would be calculating called? That's right. Jessica was first, actually. It would be tax payable. So the tax liability is the total amount of tax that they pay on that year's worth of income. Now, some of it they might pay in the year, some of it they'll pay afterwards. But once we've worked out the total amount of tax that is due on that year, we'll take off any PAYE, of which there isn't in this question, and then that leaves the amount that is still to pay, which is tax payable. Now, obviously, if the PAYE was greater than the tax liability, they would get a refund. So, for example, that'd be a situation where someone has a job, they're paying PAYE, and they also have a property they let out, and they make a property loss. So the loss would reduce their total income, but their PAYE has been calculated on their salary, which would be higher than their total income, because what the loss would offset that. That's right. Good question. Just make sure you're very aware of what we're asking for in terms of tax liability and tax payable. Anyway, we can't stop there because that is only half the question. That is Jonas. We've been asked to do the same for James. Now, to save some scrolling, I've copied and pasted it again. In the AAT mock, this box here is also a pop-out that you can move around as well. But you get 3 long grids. Now, James, for whatever reason, well, I think a rough idea, but he's worth only 5 marks, whereas it was worth 12 marks for Jonas. So let's quickly do James, and then we'll move on to something a bit more tricky, shall we? But we'll just get everyone in the mood for a bit of tax. So again, set it up. You've got non-savings, savings. And I'm sure you all know this, but always do it in that order. This is not the kind of thing to get creative with. Do it that way. If you don't do it that way, you will get something wrong. So what has James got? So he's got income from employment. Yep, we haven't got any property income. Pensions, are they taxable or are they exempt? Anyone else want to have a stab? Yeah. So this is relatively common. I see it reasonably often. Pension income is taxable. Putting money into a pension, so if you put an occupational pension, and we'll come to that later on, will reduce your taxable income. And if your employer puts money into your pension for you, that's a tax-free benefit, and the AAT do test that a lot. But when you are a pensioner and you draw down, you will be taxed on your pension. And the theory is you get more tax benefit when you put it into your pension when you were working and you maybe got kids and whatnot that fleece you dry. And then when you're a pensioner, you probably paid off your mortgage. You don't need as much income. So most of your income that you've got will be covered by the personal allowance. Unless you've got some massive crazy pension, then it's not, but that's not a problem. But either way, pensions are taxable. Then you've got more interest received and you've got dividends received. And this time we've not been caught out or tried to be caught out with a ISA. Cool. Right. Let's put some figures in and get on something more tricky. So employment income of £14,000. He doesn't have property, but he has pension of 8,500. Bank interest of 550, building society of 1,200, and dividends of 2,200. $150, that is. So then, in fact, I'm going to ask you, what's the subtotal we're going to take next? Because we are going to take a subtotal. Yeah, total income or net income, that kind of thing. So it's any. So if we've added it all up, taken off any allowable expenses, of which we haven't got any, but I'll put net income because it's shorter. But it means the same thing. And the next thing we would take off is our personal allowance. Now you can see here, we'll add it up actually before we go any further. £14,000 plus 8,500 plus 550 plus. What am I doing? 14,123 plus 8,500 gives a figure of 22,500. That would be £1,750, and obviously that would be £2,250. So that's that. Then we're going to take our personal allowance off. Right, I'm going to zoom in now because I don't need those figures anymore. Find my mouse. Where's my mouse gone? There we are. So this person here clearly has income nowhere near £100,000. So they're going to get the full personal allowance of 12,500. So that's all going to be used against our non-savings income. That gives us taxable income of £10,000. That's going to be taxable at 17,550, and that's going to be taxable at £2,250. Everyone with me to there? So now we're going to tax it. Right. So with the first bit, we're going to tax. It's going to be the basic rate of £10,000 at 20%. Even I can do that in my head. Is £2,000. So we've taxed all of non-savings. That was dead straightforward. The next thing we need to look at is our savings income. Now, this person, I mean, I can roughly see here 10 grand plus 1,700 plus 2 grand is going to be about £1,400. what savings allowance are they going to get? Although a lot of people preempted me on that. That's right. So this person is going to get a savings allowance of £1,000 because they are a basic rate taxpayer of £1,000. But again, you need to show that it's not tax exempt. It is taxable. It's just taxed at a rate of 0%. So I would always put in the fact that the tax on that is zero to really emphasize the fact you are taxing it. It just comes to zero tax. So that leaves the balance of £750 and be taxed at the higher rate of 20%, £150. And then we have the dividend allowance. Now, everyone gets the dividend allowance of £2,000, unless they haven't got any dividends, but so we don't, at 0%, you have zero. And does anyone tell me what the basic rate for dividend is? Cool. Like I say, you get these in the reference material, but to be honest, if you don't know them off by heart, you've probably not done enough tax comps. If I'm being honest, you should know these off by heart because there's not that many, and the savings and non-savings are very, very similar. But you are all right. The basic rate for dividend is 7.5%. And the reason why it's less is to reward entrepreneurs who set up businesses. So when they take a risk and they set up a business and help create jobs and build the economy, when they do take out income from their business, they will take it as dividends and pay a lot lower rate of tax as a reward. So £250 times 0.075, be careful of your decimal places, gives us a figure of, I'm going to round it in taxpayers' favour, of £18. It comes out to £18.75. In reality, it would be 75 pence, but AAT want you to work in whole pounds. And they would allow you to round up or round down because they're generous like that. So that gives a tax liability of, we're going to add it all up, £2,000 plus £150 plus 18. So we have £2,168. And you're faster than me. Cool. Right. What did we think to that? Or both of them? Because both of them would be one question. So remember, the first one was 7 marks, and the second one was 5 marks, because in the first one we went into the base high rate band, and the second one we didn't. But do we think that is achievable in the exam? I'm with you, Carly. I wrote our explanations for these because if you buy a £15 Mont product, it does explain all the AAT answers. And when I got there, when I wrote that and looked at this, I did think it's a bit easy. This, if I'm really honest, it's a bit easy because at the end of the day, if you can do one dead straightforward tax comp, you can do two. I could never keep dropping in the fact that our mock product at only £15 per unit, it covers 2 mocks and explanations of the AAT sample assessments. If you're a first intuition student, don't buy them though. You have access to them. Cool. Cool. So that's that. Like I say, if you get that in the exam, and it could happen because that was written by the examiner who thought there's a chance it's either going to go in sample assessment or go in the real exam, you could get it. But I'll be honest, if you got that, you should be counting your lucky stars. That is really, really easy. I would be surprised if you got something that easy. That's quite rare because there's certain things in here that you've already shouted at me, which I would think that they're going to examine both, if not at least one of them. Reduce personal allowance, extend the basic rate band, if not both. Definitely. So I want to look at something a bit more taxing. Well, not even trying to be funny, but something a bit more realistic, or I think it's more likely to come up. So this is one of our extra questions. It's not in your book. And Phil did send it out because I did the first. It's one of our extra tax comp questions. I did the first one in one of our live classes when we were looking at exam standard questions. And then Phil sent out both. So some of you might have seen this, but you've not seen a video debrief of this. However, what I've done to mix it up a bit, I've changed it from the lovely 5-column tax comp to a 3-column tax comp because you're going to have to do it, really. I have beefed it up a bit and given myself a few rows because you do need it if you haven't got as many columns. So here we've got, Saheed has got the following income. He's got total employment income of 105 grand. It's nice work if you can get it. Deposit account interest, current account interest, and dividend receipts. So nothing there that's exempt, nothing there to throw us out. But the more interesting stuff, we've got some PAYE, which isn't that interesting, but it comes to the fact that we've been asked to calculate tax payable, not the tax liability. But he's put some money into his occupational scheme, and he also put some money into a private pension scheme. So there's loads going on here. So straight away, you can see he's got income over 100 grand. So we've got a reduced personal allowance. In fact, looking at this, might be reduced quite a bit. And then we've also got occupational pensions, and we have personal pensions to deal with. There is lots going on. Cool. So let's get cracking, really. So the first thing, I'd set it up as ever. Yeah, increase that basic rate, Adam. I'm with you there. But looking at his level of income, we might be increasing something else as well. So I'm going to put some totals in here just to give myself as much space as possible on savings, and dividend. Now, income-wise, there's nothing here to really throw us out. It is the tax comp that is a bit of a killer. So we've got employment, on there, £105,000. Then we've got interest, deposit account, doesn't matter, as long as it's not an ISA, it is taxable. And then current account, £2,520. And then we've got dividends of £45,000. So that gives us net income. We should do it properly because we do need the subtotal for savings. I'll do this, Martin, and I'll come back to that because I like that question. 16,200, 520, not 250. And then it'll be £45,000. I think in AAT Sample Assessment 1, you get a tax comp, then you get a question about occupational and private pension. And the differences between them. So with an occupational pension, the tax benefit is taken at source, i.e. your employer takes some money off you and puts it into your pension plan. But he takes it, or she, or they, take it off you before they calculate your tax. So if they took £1,000 off you and you were a basic rate taxpayer, your taxable income goes down by £1,000. But if you'd have paid 20% tax on it, you would have only received £800 because 20% of that would be lost in tax anyway. So £1,000 goes into your occupational pension plan, and your net take-home pay would go down by £800. And obviously, if you're a higher rate taxpayer, it would have been reduced by 40%. So £1,000 still goes into your pension plan, but your net pay goes down by £600. So no matter what rate of tax you pay, the tax relief is at the correct rate. Now, with a private pension, your private pension provider doesn't know what rate of tax you pay. So all they know is, you're a taxpayer. And so what they will do is you will put £800 into your pension plan, and that is net of a 20% tax credit. And so they will go to the government and say, this person here has put £800 into their pension. Mr. Mrs. Government, please can I have a 20% tax credit? So they'll put in an extra £200 to bring your pension contribution up to £1,000, which is great unless you're a higher rate taxpayer, because in this case, your private pension contributions cost you £800 to get £1,000 in. So to get the same tax benefit, we increase your basic rate band by, we're going to do this in this question, let's be honest, we're going to increase the basic rate band by the total of your gross contribution. So increase your basic rate band by £1,000 in this scenario. So that means for an extra £1,000, you're paying 20% tax rather than 40% tax. So you're saving £200. So at the end of the day, because you put that money into your private pension, you only pay cost you £600. So it works slightly differently. The very short answer is occupational pensions are pre-tax deductions that come off your employment income here before we calculate any tax. Whereas private pensions, they're paid after you've been taxed, after the money goes into your bank account, goes out via direct debit from your net salary, and then your pension provider gets a 20% tax credit, and then from them we will extend the basic rate band or additional higher rate band, if we need to do though, in this case, and you get a tax benefit. Is the very rough and short answer to that. In terms of employer's contribution into a work-based pension, makes a difference. Yes, you know, when I said if there was an occupational pension that needs to be taken off here, that wouldn't need to be taken off there. So I was more focused on this. And remember, we have a 2% salary into there. So that would be £105,000. Sorry, I got sidetracked running off about private pensions. At 2%, which is 105, 123. Focus on the matter at hand, I should think. £2,100 gives us 102,900. Right, I'm going to focus on the question. Yeah. So we've dealt with the occupational pension, but it's the private pension as well that we've still got to do, which we will deal with in due course. So now we've got our net income. We're going to we know here that the total adjusted income is going to be more than £125,000. So they're not going to have a personal allowance whatsoever. I'm glad you found it useful. Actually, it's a good question. I like that one. But we're not going to have a personal allowance. We know this. But let's do it properly. So personal allowance, working one. So I'm going to write down to the bottom. Have I got myself enough space? We'll do it here. Working one. So this is our adjusted net income figure. You never ever need this figure for anything other than working out your personal allowance. This figure about to work out does not go in the tax computation. All it is working out what is the adjusted net income figure. We'll see if that is over £100,000, and then we'll reduce the personal allowance by £1 for every £2 that this is over £100,000. It's going to be way more, but let's do it properly. So the so we've got 102,900, and then we've got 16,520, £45,000. £45,000. But then the other thing we need to take into account of is his private pension scheme. So this also comes into the adjusted income calculation. So, but remember, so he paid £4,000, but that is what he paid. We will take off the gross amount from the adjusted income, because remember, we've taken off the gross amount of the occupational pension. So to make it fair, that it make any difference where you're better off with it occupational or private, we will do the same. So we're going to gross this up. So I'll be honest, I just do it like that. You can divide it by 18, multiply it by 100. You can do it like that if you want. I just can't. Everyone's different. If your mind works differently, that's fine. It's going to give us £5,000. So that is our gross pension income. And I'm going to be lazy. I'm going to reference that working 2 because we're going to need his gross pension contribution figure later. So that gives us adjusted income of £102,900 plus £16,250 plus £45,000 minus £5,000 give us £159,150. There is going to be no personal allowance. Effectively, that adjusted income figure, once it hits £125,000, yeah, it would be that half of that is £12,500, the excess above £100,000. There's no personal allowance. So here we have no personal allowance. So there is taxable income of, it's going to be, well, it's the same. 102,900, 16,520, don't get it wrong way around, and £45,000. Cool. So we've got taxable income, we can start taxing it. Now, the first thing is, let's get some easy marks on the board. Basic rate band. So basic rate, 37,500 at 20%, we can, I'll do this in our head, is £7,500. Then we're going to tax the next bit. Yeah, so you've got 2 choices here. You can either extend the basic rate band or you can have the excess working 2 at 20%. Either way is fine. I actually like doing it this way. The reason being, you're showing you extending the basic rate band. Now, if you just extend the basic rate band and you get a wrong figure and you don't clearly label what you do, they don't know as, have they correctly known to extend the basic rate band, or have they just used a completely wrong figure for the basic rate band? Whereas if you put 37,500 and then the extension, I would like to, if I have time, put extend basic rate band, and so that you clearly know what you are doing, extend the basic rate band, it's fine. Whereas, what is it, 37,500 plus £5,000? So if you put £42,500, it's clearly right. If you make a typing error and put 42, they're thinking, did they extend the basic rate band, or did they just make up their own basic rate band figure? Always try and make it easy for the examiner. But either way, there's another £5,000 at a rate of 20%, gives us £1,000. So now we've dealt with that. So we're going to tax the rest. So we've, of the 102,900, we've taxed 37,500. We've got taxed £5,000. That leaves us with £37,500 minus £5,000 gives us a figure of 60,400. And that's we tax at a rate of times 0.4, put it in. Figure of 24,160, yeah, like that 5, so I can read it later. So now we've taxed our non-savings. So the next bit is our savings. Now, the first bit which comes to savings is our savings allowance. Now, we know, well, we can add it up here. We have 102,900 plus 16,520 plus £45,000 gives us a figure of 164,420. I don't know why I show you because you clearly can't read that, but it's 164,420. So that figure dictates that they are a additional rate tax payer. Now, be careful, because what dictates if you are an additional rate tax payer is if you pay tax at the additional rate. Now, be careful, because we have extended our basic rate band. We're also going to extend our higher rate band. So our higher rate band wouldn't be £150,000, it would be £155,000. So as Nelly correctly said, so our additional rate band would be £155,000. So if they had taxable income of £153,000, but we extended the base rate band by 5,000, they would actually not be an additional rate taxpayer because they don't pay tax at the additional rate. Does everyone know clear what I'm getting at with there? What it dictates if you're a higher rate taxpayer or an additional rate taxpayer is not actually your level of income, but if you actually pay tax at that rate. So we could actually have income all the way up to £155,000 and they would still get this £500 savings allowance because they've not paid tax at the additional higher rate. But they've got £164,420. They are going to pay tax at the additional higher rate. Therefore, they won't get any savings allowance. Additional rate tax payer, therefore no savings allowance. So all of that is going to go, so all 16,520 is going to go into, is all going to be taxed. But be careful, we're getting close to additional rate band. So I was like, well, I would like, if I had a fifth column, to keep a running total of how much of the additional rate band that I have taxed, just so I'm careful. Yeah, Justina, extend that so you always get the tax relief at the correct rate. So if you had, say you were an additional rate taxpayer and you were employed, and you put £5,000 into your occupational pension, that £5,000 comes off the top slice. So that £5,000 is a pre-tax deduction on income that would have been taxed at 45%. So that £5,000 would have paid tax at 45%, leaving you with 0.55, giving you 2,550. So if you're an additional rate taxpayer and you put money into a private pension, you get a 20% tax credit because the pension provider takes 20% from the government, puts it into your pension. You get the 20% tax credit for extending your basic rate band because you're paying 20% tax rather than 40% tax on the gross amount of your pension contribution. And then you get the last 5% of your tax credit by the gross amount of you will extend a higher rate band by the gross amount of your pension contribution. So for that figure, you'll be paying tax at 40% rather than 45%. So you will get the correct tax saving. So it does come out in the wash, 20% from the government, 20% from extending the basic rate band, and 5% from extending the additional rate band. Whereas if you're just an occupational pension, it's just 45% tax relief at source. Yeah, and in answer to your question, if you extend the basic rate band, yeah, they will still get the £500 allowance as long as their income is not above any extended higher rate band, at which point they're an additional rate payer and they don't get any savings allowance. Anyway, to cut long story short, let's just be careful. So we've got income of 102,900. We've taxed all that. So we've got 16,520. So that's quite under the 155 it's going to be additional rate band. So we're quite confident that's going to be taxed at £16,520 at the higher rate for savings, which is 40%, which is at 6,608. Cool. So the next thing we're going to look at is the dividends. Now, this person here shed a load of money, let's be honest, but everyone gets the dividend allowance of £2,000. So that leaves £43,000 that's going to be taxed at some level. But we need to be careful now. So we're going to see how much of our higher rate, but we'll write it properly, higher rate, we've got left. And I'm going to reference this working, what are we up to? Working 3 now. So working 3, we've got a bit of space on here. Working 3. So our additional rate band is £155,000. Everyone okay why our additional rate band, higher rate band, is £155,000? Yeah, cool. So we're going to take off, what have we taxed so far? So we take off 102, oh my God, it's been a long day, £102,900, which is our non-savings income. We've taxed 16,520, which is our savings income. And then we have taxed £2,000 of dividend allowance, or dividends covered by the dividend allowance. So this is the point I'm trying to stress, is these figures, the savings allowance, are taxable, and they're using up the basic rate and higher rate bands. We don't treat them as exempt. They're using up the band. So that leaves us with the amount of basic rate band, higher rate band left, 155,000 minus 102,900 minus 16,520 minus £2,000 gives us a remaining high rate band of £33,580. So that's our high rate band of £33,580, which is at the higher rate for dividends, which is, well, I don't know why, my coffee's cold, but I'll ask you anyway. What's the higher rate for dividends? That's right, at 32.5%. You wouldn't be using a horrible electronic pen. You would type it in. Around that, £10,913. Right in the taxpayer favour. So now we've taxed up to the end of the higher rate band. So the remaining amount that we haven't taxed, which is £45,000, less the £2,000 of dividends that we've taxed under the dividend allowance, less the £33,580 that we've taxed under the high rate band, leaves us with 9,420, which is taxed at the additional higher rate for dividends. Anyone tell me what that is? That's right, 38.1. No, I don't know why it's that figure. Times 0.381. Oof, God, that's going to give us £3,589. So now we can add all these up to our tax liability. So we've got 7,500 from the basic rate band, £1,000 that was covered by the extension of the basic rate band, £24,160 of non-savings covered by the basic rate band, no, into high rate band at that point, weren't we? Plus 6,608, that was the savings, plus 10,913, which was the last bit left in the higher rate band, and then the last £3,589, which was covered by the that's taxed at the additional rate, gives us a figure of £53,770. So that's our tax liability. It seems so long ago that we started the question, but I seem to remember he did have some PAYE, and we were asked for the tax payable, 29,800 before I forget. PAYE, 29,800. £800 means tax payable of minus 29,800, £23,970. And I was beaten to it. Cool. Now that I'm not gonna lie to you. There's nothing there you shouldn't be able to do if you're well prepared for your exam. I don't think, I'm quite confident actually, you will get a question as in depth as that for 12 marks. There's an awful lot going in there. You've got personal allowance reduction. You've got extended basic rate band. You've got extending the higher rate band. You've got private pensions, occupational pensions. There's a lot going on there. There's too much there for 12 marks, but there shouldn't be anything in there that you are not able to have a good go at, shall we say. Cool. Before I preempt anything, what did everyone else think to it? I know that is quite bewildering and there's a lot going on. And if you were to do a question like this, you know, if you didn't end up with I don't want that. If you didn't end up with £23,970, do not panic. There's loads of own figure rules here. And as long as you make it clear and reference your workings, you will get lots of marks to do that. So, Pat, the figure you need to check if the income is over £100,000 is the adjusted net income figure, which is a figure you will never, ever use in the actual computation. So that is all your income added together, and you will take off any gross private pension contributions or gift aid contributions, not give as you earn. Yeah, so that gives us a figure of 159,150, and all that is that over and above £100,000? If so, we will reduce the personal allowance by £1 for every £2 that is over. And clearly, that's way over, so that reduces 12,550 down to nothing. Cool. No, I wasn't going to do any PPR questions today because we've got like 4 minutes. But PPR, I found a question that someone's already written, and they tend not to vary from year to year, so they're quite easy to knock up. So that's on my list of things to do next week. I know some of our students are going on to business tax, taught by my good colleague Anne. But anyone who's got an exam coming up soon, good luck. And I will be back for one last week next week for some more tax, just because bored, really. But yeah, good luck with anyone who's got an exam on Monday or tomorrow or anything like this. But I do want to stress with the tax computation, don't get hung up if you're not getting that, and especially if you're out by £1, because you'll get there. You'll get the mark. Cool. I'll see you on Thursday. Business tax on Monday is being dealt with by my colleague Anne. She's used to be an MD of BPP. She's dead clever, knows it far more than me. You're right, in more than safe hands with that. Cool. Medical insurance is exempt. Is that income or an expense or a benefit? It's not an exempt benefit in kind at all. Cool. Right, I'm gonna go a couple of minutes early. Yeah, hopefully I'll see a couple of you on Wednesday, but hopefully the others will go and smash their exams, and great stuff. And we will be doing business tax. When I say we, it's probably going to be me. Revision classes for business tax at the end of July into August, because let's be honest, I'm not going to go to Greece. So hopefully I'll see some of you for my business tax revision class.